With you, Jason?
Yes.
Okay. Well, thank you, Joy. And good evening, everyone. My name is Mike Hegwood. I'm the Assistant Vice President of Brokerage Marketing for AMA Insurance. And on behalf of our agency, I'd like to welcome you to our educational event this evening on the topic of tax strategies to maximize your retirement income. Before I introduce our speaker this evening, I would like to take a quick moment to thank our strategic marketing partner, Millennium Brokerage Group out of Nashville, Tennessee, for their help and their support in making this event possible. We've had a very, very long-standing relationship with Millennium, and they've been a very valuable resource for us, as well as for countless physicians that we've introduced them to through our Physicians Financial Partners program. Our speaker this evening is Mr. Jason Combs from Millennium Brokerage Group. I've had the privilege of working with Jason these past 5 years, and during that time, I can tell you that he's helped hundreds of physicians with their financial planning needs. And in my opinion, he's become quite the subject matter expert on this important topic of income planning for retirement. Jason's got a wealth of experience. He's worked on the carrier side of the business with Nationwide out of Columbus, Ohio. And these past few years has served as Millennium's Executive Vice President, where he oversees a nationwide team of financial planners and financial professionals. And somehow he still finds time to work with individual clients himself, including physicians. So again, thank you for attending this evening's webinar. We're certainly excited to sponsor this educational event and are delighted that Jason and his team were available to be with us. So without further ado, I'm going to turn it over to Mr. Jason Combs.
Well, thank you, Mike. Certainly appreciate the kind words, and certainly appreciate the partnership with the American Medical Insurance Agency throughout the years. Appreciate you guys setting these up and getting and helping us talk to some folks about this important topic. So as Mike said, our topic before us here today is tax strategies to maximize your retirement income. So as we move through this, we're really doing this, and we're going to frame this out with these topics. We're going to first look at the current tax environment, what we're dealing with. Then we're going to take a look at how taxes can impact your retirement income. We're going to look at some planning opportunities for you as a physician to take. And then we're going to look at the importance of a tax diversified retirement income plan. And, really when you look at this taxes, there's really 4 ways the taxes can play into this and be a bigger part of your overall plan than maybe you would have otherwise thought. And we're going to explore each one of these. But the first one is, it is possible that you could move into a higher tax bracket. It is also possible that tax rates could increase into the future. I would also say it's also very likely that they will increase based off of things we're seeing. And we'll look at that. It's also possible that you could have less tax deductions. And it's also possible that there could be some sort of new taxes on the horizon. We're doing a whole series of these presentations throughout the year, but I would say that this presentation is likely probably the most timely because of all the things going on around the tax package. And so what we're looking at here is the tax law that we currently have today versus the Biden plan. And so what we have today is the highest marginal income tax rate. The highest rate is 37% today. In the Biden proposal, that goes to 39.6. The highest capital gain rate, as we know today, is 20%. In the Biden plan, it goes to 39.6 for those with income above 1 million. So that's a substantial jump in the Biden plan. Social Security, as we know it today, is 12.4% on income up to $142,800. The proposed plan is to keep that the same and then reimpose the tax on any income over 400,000. So for those that are making a lot, this could have a huge impact on the amount of taxes you have to pay. The current law for corporate tax is 21%. And the new proposal, it goes to 28. As it stands today, there is no corporate minimum tax in the proposed package. Corporations with book profits greater than 100 million would be subject to a 15% minimum tax. That's an alternative minimum tax. And then when we get into the estate tax, we see some major changes there. So the estate tax exemption as it stands today is currently 11.7 million per individual. And with the Biden plan, that goes to 3.5 million. It's estimated that presently there's about 90,000 people in this country that would have an estate tax issue. With the proposed limits of 3.5 million, it's estimated that there would be about 4 million people that would have an estate tax problem based off of the proposed exemption amount. The other thing we're seeing here is they've disconnected the gift tax. Traditionally, you're allowed to gift away your exemption amount during your lifetime. What they're proposing is that the gift amount over your lifetime will be $1 million, where the estate tax exemption will be $3.5 million. And probably the biggest thing out of this whole package, and this will be, a lot of people won't catch this, but they're eliminating the step up in basis of death. So currently, you're allowed to step up basis. Under the Biden proposal, it's disallowed. And what that means, we'll take just an easy example of a piece of property. Let's say you own a piece of property, it could be your house, you paid $100,000 for it. Upon your passing, the market value of that property is now, let's say, $800,000. The people that inherit that property would have to pay tax on the gain above the tax cost basis of that property at capital gains rates. So that's a huge change. And then the last piece here is carried interest. Currently, it's taxed at capital gains rate, and the Biden proposal would be taxed at ordinary income rates. This proposal creates 3.3 trillion of additional revenue over the next 10 years. And what this graph here illustrates is the history of taxes dating back to 1913. So from 1913 to 2020, you can see here what the highest marginal tax rates were throughout that time. So if you look here in 1948, we had marginal income taxes greater than 90%. And we had a substantial time frame really here from about 1950 through the late 1960s, where the highest marginal rates were above 90%. And you really have a substantial time frame, really about half of the time, where tax rates were above 50%, really from about 1934 all the way out here to the mid 1980s, tax rates above 50%. The average over this time frame is 57%. So really, the last 30 years, since really 1990, we've been at a historic low tax environment compared to historical data. And the big challenge that affects us all is the national debt. So as we have it today, there's $28 trillion in national debt. And that number has actually grown to be larger than the total amount of GDP in this country. So our national debt is larger than the amount of production that we have. What I also find very interesting about this number is it actually closely correlates to the amount of assets that are currently held inside of qualified retirement accounts. That's 401ks, IRAs, 403bs. If you research that, you'll find that the amount of assets in those type of plans is very close to the amount of debt this country carries. And, up until, the last 30 years or so, the narrative in this country, when it comes to saving for retirement, has really been, to defer taxes now and pay them later in retirement, with the thought process that taxes are lower, would be higher because you're earning more money, but when you're in retirement, they would be less. The challenge is that we're actually seeing that people's lifestyles, when they enter retirement, because of inflation and everything else, they're not spending a lot less money. They're actually needing to replicate the amount of money that they were having pre-retirement to maintain their standard of living. And, as long as we continue to carry this debt, interest rates are going to remain very low. And when you have low interest rates, you're going to have high inflation. Here's a question that I like to throw out to people here to kind of make a point. But let's say you're in retirement and you've got your income plan set up and you're doing good. You're living a comfortable lifestyle. You're doing all the things you want to do. Everything's good. You have some grandkids and you decide that, you want to put a pool in. And so you get some quotes and you find out it's going to cost you $100,000 to put a pool in. And so the question is, if you are already taking money out and you want to take out 100 to put the pool in, that's going to put you in a 32% tax bracket. So if you need to net out 100,000, what do you have to take out of your retirement account to net out $100,000 if you're in a 32% tax bracket? Most people would answer you need to take out 132,000. But if you take your calculator out and you take 132,000 and you times it by 30 times 32%, you're going to find out that that's 42,000. So if you take out 132, you're going to have to pay tax on 42. You're going to pay a tax of 42,000. It's only going to leave you with 90. You're 10 grand short. So in order to net out 100, you got to take out 147. And this is where we start to see problems with people not fully understanding the tax impact on their retirement accounts. So as we talked about earlier, there's 4 ways the taxes can be a bigger impact in retirement. The next thing we're going to look at is your tax deductions. As you enter into retirement, you actually are going to lose a lot of the tax deductions that you currently take today. So if you look at the 3 biggest tax deductions that most people take, one is they're taking a deduction based off of the mortgage interest that they pay on their mortgage. Well, when you get into retirement, hopefully you've got your home pretty well paid for and you're not carrying a big mortgage, and therefore you lose that deduction. The same with your children. Your children are going to be grown, moved out of the household. You no longer get a tax credit for your children. And the third is you're no longer making contributions to your retirement plans. So you're no longer getting that tax deduction. So there's less tax deductions in retirement. And that's something that you have to take into consideration. The next thing we're going to look at is Social Security and Medicare. And this is what's called provisional income. This has been around since the mid-1980s. And there's still very few people that fully understand what provisional income is. But what that says, and it's, you got to read up on it to get the full thing here, but what it says is if you have taxable income greater than $44,000 in a given tax year, that 85% of your Social Security will become taxable. So if you have less than $44,000, not as much of your Social Security becomes taxable. So it's more important to create that tax diversified income stream because you have more control over the taxes that you pay in retirement. The other piece of this, the more income you report, the higher your premiums will be, your premiums and deductibles for both Medicare Part B and Part D. One of the other areas that we said that it's possible that you could be moved into a higher tax bracket. So here we have a couple. Again, they're living a happy lifestyle in retirement. They're doing all the things they want to do. And they're pulling, they're taking a couple $100,000 out of the retirement accounts to maintain this lifestyle. And so as both of them are still alive, that $200,000 of income is going to put them, if you look here, at a 24% tax bracket. However, if one of them were to pass away, now they have to file as single individuals, and now they're going to be pushed into the 32% tax bracket. It's a big change. So to recap, it's possible to be moved into a higher tax bracket. As we can see with the Biden tax plan proposal, tax rates could increase. You could have less deductions in retirement than you do today. And we could see new tax laws come into play. Right now, in the state of Washington, Washington's got a proposal out, Washington State, that basically says that you have to have a long-term care policy. And if you don't, they're going to start hitting people up with a 0.5% state income tax. So we're seeing new tax laws put into play quite often. So to fully understand the impact of these taxes in retirement, you next have to kind of look at the different retirement savings vehicles that are available today and how each one of those are different and how the taxes on each one of those are treated. And when you think about a retirement plan, we're going to look at it from three different phases. You're going to look at what's called the contribution phase. That's where you're putting money aside into the plan, and then hopefully your investments inside of that plan grow based off of investment returns, based off of interest rates. And then when you get into retirement, you're going to take distributions out of these plans. The way the tax law is set up at the present time is that you have to pay taxes on one of these three buckets. You either have to pay taxes on the money you contribute, you have to pay money as the investments accumulate or grow over a period of time, or the third option is you pay it as they are distributed. The good news is you get to decide, and it depends on the investments that you choose. So here we're going to look at a typical investing scenario where a person is contributing $10,000 a year for 25 years. They've done very well, actually a 6% hypothetical growth rate. They've done very well. Their assets accumulate over a period of time to $581,000. And then they're going to begin distributions over a 25-year period of time of $42,800. So over those 25 years, they pull out over $1 million. So they put $250 in, it grew to $581 at retirement. And based off of the distributions over the retirement years, they pulled out a little over $1 million. So if you were to make the choice, which one of these three buckets would you pay tax on? I would make the choice to pay tax on the $250. However, most of the retirement assets are going to be taxed as you distribute those. And that's why creating this tax diversified income plan is so important. So let's look at an example here. So we have a person that's entered into retirement. They need $100,000 they're going to take $100,000 out of their qualified plan. So when I say qualified plan, that's talking about your 401k, 403b, your IRA. When you take out the $100,000, it's all going to be taxable. Your effective tax rate based off of this example is 32%. That's going to leave you with an after-tax amount of $68,000. If we look at just diversifying the investment mix of your portfolio, to be able to control which assets you take income from in retirement, you're able to get out $85,000, which is $17,000 more than the other example. And you do this by taking a third out of your qualified account. You take a third out of your mutual fund account, which is tax at capital gains rates. And you take a third from what's called a tax-free bucket. And so this 17,000, if you spread that out over a 17 or a 20-year retirement, that's over $300,000 in income difference. So it's a big difference. So if you start to understand the value of the different investments, now you have to really kind of start understanding how each one of these investments are taxed. And so we're first going to look at what most everybody has some sort of qualified retirement plan. Again, that's your 401k, that's your 403b, that's your traditional IRA, your pension plan. On these type of, so this is the yellow bucket. On these type of plans, your contributions are tax deductible. They grow tax deferred, but all the distributions in retirement are subject to income tax. As we move over into the blue bucket, we would call these our non-qualified assets. These are after-tax purchases, so we do not get a tax deduction on the front end, but they're generally taxed at capital gains rates. And based off of the current law, capital gains rates are generally lower than ordinary income rates. And then the green bucket would be no deduction on the front end, but you would be able to take the money out tax-free. And this is where we're going to spend the majority of the time today. And there are three options in this green bucket. We have life insurance, we have Roth IRAs, and we have municipal bonds. Those are the three options. We're going to call the tax-free bucket, we're going to call that the tax-preferred bucket. And if you're interested in slashing your taxes in retirement, these are the way these work. So we're going to start with the Roth, and we're going to look at the benefits of a Roth versus the downside of a Roth. So as you look at the benefits of the Roth, it accumulates tax deferred. There's no tax on qualified distributions. So that means you can take the money out tax-free. There are no required minimum distribution for the owners of a Roth IRA. So if you're comparing this to a traditional IRA, with a traditional IRA, you are forced to take money out at age 72 and pay tax on it. The Roth IRA does offer an income tax-free benefit to the beneficiaries, and you have a wide range of investment options to invest your money in. The downside of Roth IRAs are pretty much around the amount of money that you can put into it. So you're limited to $6,000 per year. And if you're over 50, you can put in $7,000 per year. You're also limited if you're a high income earner. So if you're filing your taxes as married, filing jointly, you cannot do a Roth IRA contribution if you make over $198,000. The contributions are not deductible. You do have to wait till you're 59 and a half to be able to pull the money out of a Roth IRA without a penalty tax. And you also have to wait 5 years from opening the account to take qualified distributions. Your beneficiaries do receive the death benefits income tax-free, but are then required to begin to take a withdrawal on those accounts. If you do not qualify for a Roth IRA based off of your income, you can always do what's called a Roth conversion. If you do some self-education around these topics, you may also find it called a backdoor Roth. But that's basically where you take money that's inside of your IRA account and you convert that to a Roth. You would do that to create tax-free income in retirement. The benefit of that is you get around doing a Roth conversion is you get around the income restrictions and the contribution limitations. The downside is you're paying tax on the amount that you convert at ordinary income tax rates. You still have to wait to 5 years to take free withdrawals. If you don't have any type of Roth set up as you get closer to retirement, it's a really good idea to get one set up. If you want to do a conversion, that way you can kind of start the 5-year clock ticking. And if it's possible to make some contributions based off of your income, you would be well advised to get some of that money into a Roth. The second option here is municipal bonds. They are tax exempt from federal and maybe state and local income tax. They're low volatility, low default risk, but on the downside, they have limited growth potential. I looked at a 10-year bond before this call, a high-rated bond. You're looking at a yield of around 1.8%, 1.7, 1.8, that ballpark range. So at 1.7, 1.8, you're not even keeping up with inflation with municipal bonds. The other challenge you see in the bond market is if interest rates go up, the market price of bonds go down. So your marketability of these in the secondary market may be limited based off of where interest rates go into the future. And considering they're basically at an all-time low, they really don't have much where else to go but up. Even though they're tax exempt, they are still used in the calculation to figure your Social Security income tax. And they could be subject to state and local tax depending on which type of bond you buy. There are no current deductions for municipal bonds. The third option that we're looking at here is the life insurance. The benefits of life insurance, they offer tax-free withdrawals, as we've looked at, tax-free to the beneficiaries. There are no contribution limits to the life insurance plans. There are no income limitations to the plans. They do grow, the assets inside of the policy do grow tax deferred. There is no 59.5 rule with life insurance. They do offer protection from creditors, depending on the state that you live in. They do offer a wide range of investments from fixed accounts to variable sub-accounts to index accounts. And many policies, you can do tax-free exchanges between the different investment accounts. There are no required minimum distributions, and they are considered self-completing in the event of a premature death. So they offer a death benefit to your surviving family members that can complete the plan and give them assets to continue their standard of living. The downside of life insurance, there is a cost of insurance associated with the product or with the plan, and we'll look at that a little bit. You do need to qualify from a medical standpoint, so you need to be healthy. You need to be able to pass an insurance exam. A lot of people don't like to go through an insurance exam, but that's part of the deal. You got to qualify both medically and financially. So you have to have the financial justification to buy the insurance. And I will tell you right now, based off of COVID, because of increased mortality and because of the low interest rate environment, it's life insurance is getting a little harder to get. There's less carriers in the space. Low interest rates put a strain on these products, and the increased mortality is so the carriers, the insurance companies are sharpening their pencils on who gets issued a policy. There are no tax deductions in the current tax year. However, there is one exemption to this, one exception to this, and that's under Section Code 162, which if you're a business owner and you can bonus yourself as part of your compensation money to pay for these policies, and you can write that off as compensation inside your business. Another downside is you do need to be very disciplined in funding this type of investment. And if you do a lot of research into this, you'll see a lot of marketing that says they're flexible premiums. You can make up missed contributions, which is all very true. But in reality is if you commit to one of these, you really got to stay the course and make those deposits on schedule. If you start missing premiums and missing your deposits, the things can get off track very quickly. The other perceived downside to this, they do need some time to fully reach their potential. So we're getting close to the end of our presentation here, but we're quickly going to go through just a little bit of a case study. Here we have a physician, age 40, great health. He's making $400,000 a year. He plans on working through age 67 and then doing a full retirement. His financial planners work with him. They've set up that they have a goal of putting away 10% of their income, $40,000 a year. He's maxing out his 401k at 18 a year, leaves him $22,000 to do some other stuff with. So he looks at throughout the marketplace, decides to buy a life insurance policy and fund it with the $22,000. It's 27 years till he reaches full retirement at 67. He's got life insurance from the very beginning of $403,000. I put another just to see how this grows over a period of time. His family's protected throughout the entire policy at age 60. He's got over $1 million of life insurance. And at age 67, he's accumulated a cash value of $1.2 million that he can access tax-free. Now, I want to point out that we ran this illustration at a very conservative 5%. Now, if you do a lot of research into this or you talk to some other people, you got to be very aware of these illustrated numbers. You know, some people will illustrate 8%. By law, you can go up to 12. We've taken a very conservative approach here at 5. 5 is roughly what the 30-year look back on the S&P 500 inside of these type of policies has been. So this accumulated value of 1.2 allows him to take out $78,000 over a 25-year period of time, which equals about $2 million. If you compare that to what that would look like if he was in a taxable account, and assuming taxes go up into the future, now we're at a 35% tax bracket. This $2 million that he's able to take out would be equivalent to $3 million in a taxable account. So we're not suggesting that you do 100% of your investments in a product like this. If you go back to our previous slide where you take a little from here, a little from there, and some from over here, it gives you a lot more control in the way you're taxed in retirement. So I put this slide in here because I think it's important to understand this. If this is a concept that you have interest in, you know, the most commonly when you're buying insurance, what you're looking for is the most amount of insurance I can get for the least amount of premium. You know, that's most of the time what people are looking for. You're buying term insurance. You want the most amount of insurance you can possibly get for the least amount of premium. However, with these products that are specifically designed to build cash value, you actually buy it with less insurance. So the goal is to buy as the least amount of insurance as we possibly can. When we buy the least amount of insurance that we possibly can, we allow this to grow over a period of time very, very efficiently. And when we get to this point right here, where everything starts to trend upwards, the amount of insurance that we're carrying is very, very minimal. It's just enough to satisfy the IRS code that defines what insurance is, and that's IRS code 7702. And some positive news, we actually earlier this year, January 1st, the 7702 was amended that allow policies to drive this death benefit down even further and act more like an investment than ever before. So we have some things that in our favor in these type of investments that we did not have before. Now, the yellow line represents the premium that we put into the policy. And when the way these work is you're always able to take the money out of these policies income tax free. And because life insurance is from an accounting standpoint, is a FIFO deal, first in, first out. You take out your principal, your investment first. You're able to access the remaining cash value through policy loans, which are also tax free. You take that out to a point where there's very little left in the policy, but you would still have some life insurance to serve as a final expense measure. And obviously, if this is something that you want to dive further into, we can obviously walk you through the different scenarios there. So as we're kind of wrapping things up here, the question is really in my mind, do you want to take a micro approach to taxes, which if that's the approach, that approach is to reduce taxes in the current year that you're in now, or do you want to look at it from an overall or a macro sense and reduce taxes over your lifetime? We have a ton of tools that we can help you take a look at this. On everybody's situation is different. There's no way we can advise people without a conversation and understanding your situation and what your goals, what they look like. But we have a lot of tools at our disposal that can put these in a framework that helps you understand the opportunities and the risk and the downside and the pros and cons of it all. So I appreciate everybody's time. Mike, I'll turn it back over to you and let you kind of wrap up the call and open it up for any questions that we may have.
Yeah, thank you, Jason. Appreciate your insights on this very, very important topic. Before I wrap things up here at the end, do you want to take a few questions now?
Sure.
Okay. Joy, are there any questions through the chat function that we could address?
Yes, we do have a couple. I'd like to start with just a reiteration of the income limit for a single person with a Roth.
Okay. For a single person, I would have to look at that chart for you. We can easily send that to you if we have your email address. I can email you that information. I believe it's like 120 to 130,000 for a single person.
Okay, thank you for that, Jason. So if you could just type in your email address, we will get that off to you to confirm that amount exactly. I have a couple of more questions, and this is referring to there are retirement plans offered by some employers that allow for post-tax retirement contributions, essentially a Roth-like IRA.
Right.
Can you go over that just a bit?
Sure. Yeah. Thank you for bringing that up. That's a point that I meant to make during the conversation of the Roth, but you are absolutely correct. Many employers also offer what's called a Roth 401k plan. I know here at Millennium, we offered it. My former employer at Nationwide Insurance, they offered it. But if your employer offers a Roth 401k, they should give you the ability to either contribute to a traditional IRA or to a traditional 401k or a Roth 401k. And most everything works the same. You do not get the same tax deduction that you do on a traditional 401k. So you don't get the tax deduction. The assets still grow tax deferred, and you can get to those assets at a later time tax free.
Thank you, Jason. That was helpful. Just a few more questions. Someone asked, how is payment for our services determined?
Yeah. Well, that's a really good question. I guess we have some different types of models. Some of our folks that are, if the screen's still up with our team, we do have some that are full-fledged financial planners. They do full-fledged plans. I guess we all have that ability to do full-fledged plans on our team, so that there could be some things we can do for you there. Depending on the types of products you buy, some of the products have commissions. So if you're buying a commissionable product, that is how we are compensated in the financial business. So it's either through you're either going to be assessed a financial planning fee, depending on the types of investments that you do. You know, there could be an ongoing management fee, or there could be the products themselves could offer some sort of commission. All that would be disclosed to you prior to, you know, the implementation of any of those plans.
Thank you, Jason. We have just a couple more questions here. Going back to the Roth conversions, is there any chance that there would be a tax on Roth distributions at some point in the future, essentially a double taxation?
Yeah, I think the code is pretty clear on that, that they would not do that. Now, I think it is very possible that they do away with Roths, but I think anybody that has purchased a Roth or purchased one while the current tax law still stands would be grandfathered in to the tax environment that they purchased it. And based off of other tax changes they have made in the past, they've always grandfathered people in. But I do believe it is very likely that we will see the Roths go away at some point in time down the road.
Okay, thank you, Jason. Just have a couple more here. For an income over 200,000, what are backdoor options for a Roth IRA?
Yeah, so you really have two options. If you have anything that you've already contributed to an IRA, you can always convert that to a Roth. A lot of 401k plans will have what's called an in-service withdrawal. So even though you're still employed, you're still working, they will identify some amount, like a third is a general amount that you can take out of your 401k and move that into an IRA. That is, when you do that, when you make that transaction, that's totally tax-free. And then you could take the amount in your IRA and convert that into a Roth. So that's two options. The third option is you could actually do a non-deductible IRA contribution and then convert that into a Roth IRA. So those are the three options that you would have available.
Okay, last question. Someone mentioned a 457 plan. Is this a Roth-like account?
There's 457s is a totally different animal, and no, it does not have Roth-like characteristics. Most of the time, a 457 is there's a couple different types of 457 plans. There's a deferred compensation plan. Most of the time, that's what it's a 457F plan, which is a deferred comp, which means that you're deferring your compensation to a later time. But when you take that, you take it as compensation, and that would be taxable to you.
Okay. Thank you very much, Jason. I believe we've hit on all of the questions. There's a few things that will follow up to emails that were referenced, so thank you for sending those. Mike, I'll turn it over to you.
Okay, thanks, Joy. And again, thank you, Jason. Appreciate you taking a few extra minutes to answer some of these questions. I would like to invite anyone that has some additional questions or simply would like to continue this discussion. Jason and his team have agreed to make themselves available. There's an email on the screen right now, jasoncombs@mbgnow.com. If you are interested in furthering the conversation to learn more about the topic, I'd encourage you to send an email directly into Jason, and he or one of his teammates will simply get back to you and schedule a time that's convenient to further the conversation. So we wanted to make sure you knew that was available. And lastly, I'd just like to again say thanks and to let you know that we will be sending an email as a follow-up. Your feedback is very, very important to us. As Jason said, we are going to plan to have a few more of these events throughout the course of the year, and we'd like to take your feedback and continue to make these as that they fit what you're looking for, and we continue to incorporate your feedback into future sessions. So the survey that we will send is very, very short. If you would take a minute or two to complete that, it would be greatly appreciated. And with that, I'll just simply wrap things up by saying thank you again for attending this evening, and I hope you all have a good evening and the rest of your night. Thank you again.
Thank you, guys.